Hi there, my name is Ashley Micciche, CEO of True North Retirement Advisors, where we specialize in retirement and exit planning for business owners. I'm here with our founder and president, who also happens to be my dad, David Wilson, and we're here talking about what the heck is going on in the stock market, in the economy. It's mid-August. The Fed has the Fed has cut interest rates. Trump has slapped tariffs on Chinese goods. What the heck is going on out there? We're here to kind of summarize for you, bring it all together so you can turn off CNBC and just get to the meat of what's driving the markets, what's driving the economy, and most importantly, what's driving your portfolio. Before we continue, please be sure to like, comment, and subscribe, which you can do so by clicking on the little red button in the bottom corner of this video. Be sure to like, and if you have a question, please leave a comment. If you think that we have no idea what we're talking about, that's fine. You can leave a comment there too. At the end of July, very end of July, the Fed lowered rates for the first time in over a decade. And the market reacted very strongly.
Yeah, we had a very strong July. Market actually, for the first time ever, reached all-time highs and got over 3,000 on the S&P 500 index because it was anticipating the Fed finally getting with the program and cutting interest rates. As soon as they finally did it, I think Trump was waiting for him to do it. He slapped on some new tariffs. That were going to go in effect September 1st, 10% on additional 300 billion of goods. But now that has been right now taken off the table. When we've had other tariff increases or announcements in the past, the markets dropped between anywhere from 5 to 10%. After Trump announced this one, immediately in the first couple of weeks we dropped 6.7%. So it was very typical. I think the difference from other recessions that we've had in the past is those recessions, they were deep, and then we came out of it very, very strong. This one we came out, and I mean, it's the slowest glide path. You wonder if the plane can take off.
To get off the ground.
It's been a very slow, over 1-2% annual growth rate, which isn't very much in past. We've grown, average of 3%, and coming out of those 5 to 8% sometimes GDP growth. And our economy is strong. In fact, it's the strongest developed economy in the world. I don't see any reason why we can't continue.
Mm-hmm. Yeah, you look at corporate earnings, business earnings are still strong. Now they're not as robust as they were last year or the year before.
That's coming off a big tax cut year.
Yeah.
Interestingly, we're at 50-year low on unemployment. We've got wages rising at a very strong pace, and we've got low mortgage rates. So all of those things should really be very strong for housing. And yet we've kind of hit this, I don't know, not a bump in the road, but basically the housing market has been a little soft. And the reason is, I think we've priced out a lot of those new home buyers, which tend to be more younger people, who want to come in and buy a home. So
we've talked about what's going on in the stock market, the economy. What the heck is going on in the bond markets right now?
I've never seen anything like it. This is crazy. Okay, there are 15 trillion. Like every week it's another trillion, right? There's $15 trillion of money around the world, principally in Europe and Japan, where people have their money in the bank and they're actually paying the bank to safeguard their money. Who ever heard of that? So you get a minus 0.6% for 10 years on the German Bund, and even more on, a lot of other currencies are similar, but they're negative. And here we are, you could get 2%. Well, right now it's 1.6 on a 10-year treasury, and it's dropped significantly in the last few weeks. Because so much money around the world, if I'm getting negative in Germany, the money's flooding over here. It's pushing the dollar up, which is not helping us with our trade negotiations, and it's not helping our countries, our companies that are trying to sell overseas. Yep. That's why the Fed, and we've been saying it, they're going to cut more, maybe 3 more times, a couple more times this year, and maybe between now and March, maybe 3 times, a quarter point. The low was 1.3 3% on a 10-year Treasury back in 2016. I think we could hit 1%. I'm not going to predict today that we would go to negative interest rates, but I think we can go a lot lower. So if you have a mortgage you want to refinance, great time to do it. Rising dividend stocks even make more sense. I mean, if I'm going to get 1.6% on a 10-year Treasury, if I put that same money in a rising dividend portfolio, I'm going to get around 2% dividend. Those dividends tend to increase 7 to 8% a year in and year out. So think of that compounding over 10 years. And then you have the appreciation potential. And we're talking about high quality.
Not high dividend.
No,
but
high quality, high consistent payer. Yes.
Yeah. I think we want to be clear in saying that you shouldn't trade in your bond portfolio for dividend stocks, but it should be definitely an area of focus within your stock portfolio.
What you need to do is you need to be balanced with your investments. In other words, you don't, commit everything to the rising dividend stocks or bury it in the backyard. You basically determine your allocation. If we do get to new all-time highs, if between now and the end of the year the market rallies, maybe then you ratchet back some of your stock holdings. But the thing is we're 5% or 4% below the all-time highs, so we're still pretty close, pretty close to the highs. So I think you need to be balanced. In other words, stick with whatever your allocation should be, and if we start going back up to new highs, you lighten up on stocks. If we go down 10% or more in a correction, then maybe you nibble at stocks a little bit.
What other areas of investment are you excited about or focusing on more?
I still like value because everybody hates it. So usually when everybody hates it, that's a good time. It's not that I'm betting the farm on value, but in a diversified portfolio, if I have new monies to invest, that's an area because I think you get a good yield, and I think the value stocks are attractive here.
Let's talk about in summary. Fed's cut rates.
There's a
Trump
rate.
slapped tariffs on.
So
there's like a, kind of an evening out there. Now, the market's been very volatile.
Yeah.
The economy is still showing signs that it's growing. Now, the growth rate might be slowing down a little bit, but we're not.
Yeah.
It doesn't seem to be that we're anywhere near a recession in terms of where the economy is. And then, of course, with interest rates going down, that's helped prop up the value of your bond portfolio, but it's hard to kind of find the income and the yield. And so rising dividend stocks and value stocks both present a very interesting opportunity for finding income in a very low interest rate environment. What else do you want to add to that?
I think we're now in the dog days of summer, August. August is typically one of the worst months of the year in terms of performance of the stock market. So what's going on is no surprise, and everybody's away, on vacation, or they're doing their thing, and the market tends to be more volatile. And so here we are, we're getting that, and I think things will settle down. And we've got, again, the overriding factor is that we've got a race to zero around the world on these interest rates. Our market, I think, is going to be fine, and because we are the beacon out there, and we continue to grow at a nice pace, 2.5%, I think is going to be fine, and earnings will pick up in the latter part of the year. So I think you stay the course.
Thank you so much for watching. My name is Ashley Micciche, here with David Wilson, founder and president of True North Retirement Advisors. Be sure to like, comment, and subscribe. Have a fantastic day. Let me
blip, 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 blip.
But let me
finish the sentence.
Let me prompt you, yes, and please don't interrupt.
Good luck.
Okay.